Do you feel as though investors are still in that mode of wanting to buy mega cap technology when it goes on sale?
We think ultimately they will be, even though those stocks came back last week. They're one of the few groups that's selling at very attractive valuations. So you can buy a lot of them at 15 to 17 times earnings. So we think if you do have a 9 to 12-month time horizon, we think there's some great opportunities there. Apple, Microsoft, Google, Facebook, all really compelling prices right now.
So if you feel as though that's the case, I mean, you're talking about this kind of 9 to 12-month horizon. We are seeing again some of the weakness in futures markets right now coming out of this holiday weekend. What goes on a shopping list for an investor such as yourself, given the recent price action that we've seen? It has been pervasively to the downside. This kind of near-term uptick may be comforting for some, but do you expect those prices to go down even further in the coming weeks?
Short term, this market is truly impossible to predict. So what we think you have to do as an investor is look at companies, try to set prices that you think are attractive in terms of a valuation basis, and then buy the weakness. Buy days like today. Don't chase rallies like last week. We think that if you have that longer time horizon, you're able to take advantage of the opportunities. If you're looking to call a low, that's really an impossible exercise. The only time we're going to know that there was a low is if you look 3 to 6 months later and say, okay, boy, the market did bottom out there. We think you really can't do that as a trader. We think the much better way to be a successful investor is to buy really good businesses at attractive prices. More likely than not, they might go down a little bit lower after you buy them, but 9, 12 months later, they should be a lot higher. A company like PayPal, which is off 60 or 70% from its highs, we think has good long-term prospects. You're buying a great growth company, and you're buying it at a GARP price. You're buying it, say, 17 times next year's earnings, which is pretty attractive.
So you kind of read my mind there, David. I was just about to ask you about the shopping list. So PayPal's on there because you think it's a good business trading at a discount valuation that has growth prospects ahead. What else fits the bill? Because I can think of a lot of stocks within the S&P 500 and NASDAQ 100 that are down 20, 30, 40, 50 or more percent from their highs. But what characterizes a good business in your mind?
I was going to say being down is not necessarily the buy indicator. What it is a good franchise with long-term revenue and growth prospects. And if you can buy it at under 16 times earnings, we think it can be pretty attractive. And we think there are a lot of growth stocks that have fallen out of favor, like that Google or Facebook, that have gotten down to those valuation levels. Starbucks is down very significantly this year. It's a little bit more expensive, but it's a very good company. The CEO just bought $15 million worth of stock. We'd also like the financials. Companies like Truist Financial is selling under 10 times earnings. Goldman Sachs is at a very attractive price. So it's really spread out. Unilever is in the news today. Trian Partners took a 1.5% stake. They put Nelson Peltz on the board. This has been one of the largest underperformer consumer staples, consumer product companies. So we think it has a lot of catching up to do. Management has really underperformed. So we think Trian getting involved is a real good thing and should catch up to other consumer staples that have done a lot better.
David, before we let you go, you mentioned consumer staples, an outperformer in the market volatility. Where else in consumer staples do you look for value besides Unilever?
So we have 1 or 2 companies there. We have Kellogg, but those companies have done really well. So they're closer to the upper end of their trading range. So for new monies, we think they're much better places than consumer staples. Right now, the Unilever is the consumer staples that's got to do some catch up, and we think it's got a lot more upside. So that's where we'd put new consumer staples money. Otherwise, we own some in the group, but we're less inclined to throw new money at that area.
And really quick before we let you go, what do you stay away from?
We think the things that have done real well that are selling at the upper end of the valuation, like utilities, have had a great run, but they're selling at 18 to 20 times earnings, where you're able to buy much faster growers at much lower multiples. So we'd be taking profits in some things that have done well, like the utilities, and redeploying that money into some of the laggards at lower valuations.